Thanks, Eric. Thanks, Joe. I'm going to focus on the international aspects of the tax reform proposal, and I'm going to talk generally about a sort of a blend of the blueprint and the Trump plan. And so, focusing on that, the international aspects are truly transformational. Some other aspects have some very dramatic changes to the tax system, but the international aspects are transformational in a couple ways. The first, as Eric mentioned, the territorial system. And that is something that initially wasn't espoused by Trump. Trump had a full inclusion proposal in his campaign approach. And then he sort of reversed course in April and probably, I think, affected by advisors such as Gary Cohn, who's his chief economic advisor, and probably Treasury Secretary Mnuchin as well, to go to a territorial approach. Now, neither the House blueprint nor the Trump plan make any reference to how they would deal with base erosion under the territorial approach. So they talk about the goodies without the medicine so far. Foreign countries don't really consider this to be a big change. From their standpoint, they think the CFC regime with the deferral of income and check the box and so forth effectively produces the same result. A transitional issue in connection with the territorial system is the repatriation tax, and that gets a ton of attention from practitioners because they're looking at the offshore earnings and profits as a bullseye for or a basket into which the government's going to reach. And there's a lot of politicking about the rates and a lot of planning about the base. The second transformational aspect, and the one I really want to spend most of the time on, is the border adjustment provision. So the border adjustment aspect of the destination-based cash flow tax. The proposed regime is described as a destination-based cash flow tax, which means it's composed of several of the other pillars of the blueprint and the Trump plan as well that Eric mentioned, which in particular full expensing, no net interest deduction, and then some sort of border adjustment has a result that produces something very similar to a consumption tax. So that is completely based on, or the transformational aspect of it is based on that border adjustment, because if you think about it, you could very easily under the current origin-based system fit in full expensing. Requires a lot of changes to the reorganization provisions and so forth, partnership provisions, but you could fit it in. And you could fit in, and certainly a denial of the interest deduction has been popped up from time to time. So that could fit in conventionally, but the border adjustment aspect is unique. It's also unique in the world, so that's something to remember. It's not really a VAT. It allows a deduction for compensation. It does not allow immediate payment back from the government or refund or a credit. And in that sense, it's not like a VAT. And it's also unique in that it will replace the corporate income tax altogether. And that's really, really a significant point. And it's one of the aspects of that should be noted is the distribution effect of that kind of approach. And Eric mentioned the distribution effect as being important. So a corporate income tax is sort of it's a supplement of the VAT in most systems, and basically in every system that has adopted the VAT or a GST. And it deals with regressivity. It prevents a regressive tax because it deals with essentially the premium returns. And without that, there may be some issues there. This border adjustment tax would be structured under like a subtraction method VAT. So, and it's purposely like that to look like an income tax, so it doesn't look like a VAT. The only country in the world that's got a subtraction method VAT is Japan. The others all have a credit invoice method. So the subtraction method basically says, here's your receipts, take out the cost of goods sold, pay the tax on the balance. And in the case of the border adjustment tax, you take the receipts minus the capital expenditures, minus domestic inputs, minus wages, which is unusual, as I said, and then that's the tax base. So the points I want to get across are that even though the border adjustment aspect of this international regime is very well intentioned, that it will go through some of the issues, and I'll just highlight some of them. It is so complicated, never been done before, and it obviously runs through the fabric of our tax system, that I don't think it can be recommended, certainly on a unilateral basis and in this kind of a short time frame for analysis. And I think I think the administration feels that, although, and I will say, Trump in the Economist interview on May 4th, which then was released on May 11th, said, well, we're not really, border adjustment tax, we're not really considering that, or we're not really into that. But then Mnuchin, I think, said just some days later that everything was still on the table, and they weren't saying they wouldn't consider it, and so it's still out there. And I will say that as best I can tell from inquiries made, and that the House is still very much wedded to this approach. And one of the reasons is it raises revenues to pay for the goodies that they want. So the goodies they want are the rate reduction, full expensing, and so forth. And how do you do that without this revenue? We'll get to that. It raises revenue because the U.S. is a net importer. So because it's a destination-based tax and the U.S. is a net importer, it actually raises revenue. If the U.S. were a net exporter, or when the U.S. becomes a net exporter, it will lose revenue. The second benefit is that it largely, pretty much eliminates transfer pricing issues on cross-border flows from a U.S. standpoint, not from the foreign country standpoint, increases them from a foreign country standpoint. And it alleviates inversions. So it's not so clear that there's still not an advantage to have a foreign company. And that may depend to some extent on what other countries do to income tax treaties. Because if they decide that this is a violation of the treaty and to cut back on benefits, insist on renegotiation, the U.S. may not be such an attractive holding company jurisdiction, even with territoriality, if the withholding rates are too high. And then there have been, the third benefit that has been referred to has been walked back from by the sponsors, at least as best I can tell. It's certainly been muted in the conversation. And that is that it was touted as being a generator of investment and inflows of cash into the U.S. And the fly in the ointment there was when the economists piped up and said, there's going to be adjustments to the foreign exchange rates, and all of this is going to be neutralized, and so we do not expect there to be any favoring of exports or disfavoring of imports. We expect it to be essentially the same before and after. So there may be an increase under the plan in investments in the U.S., and there likely will be, but it would probably be more as a result of full expensing or some variation of that than this, and the reduction in rates. So those are the perceived benefits. What are the issues? And this is, one could go on forever on the issues. I listed 16 of them. And within those 16, there are a lot of sub-issues, So I won't even highlight all the 16, but so I'll just start with how the Senate views this. Mark Prater spoke on Friday. Mark Prater is the chief tax counsel for the Senate Finance Committee. He spoke on Friday at the EBA tax sections meeting in D.C. And he said some of the issues that the Senate has that they want to pay attention to is, first, who bears the tax? And that's very unclear. What's the incidence of the tax? Is it like the corporate tax, which is thought to be, although data is very unclear, the people guess it's 75% on the capital investor, the shareholder, 25% on labor? Or is this one more on is it more on the shareholder, or is it on the consumer? And then is some portion, because of the wage deduction, that's not borne by the shareholder or the consumer because it's deducted, so that must be borne by labor. They're trying to figure that out, and it has a lot of relevance to, again, the distribution impact of the tax. A second issue they're concerned about is the impact on trade agreements. They referred to trade agreements, Mark referred to trade agreements. He did not refer to treaties per se. The trade agreements are obviously the GATT and the WTO, and of the WTO, and NAFTA and the free trade agreements. And most attention's been paid to the WTO rules that you cannot reduce you cannot reduce an income tax on exports. Literally, it says you can't reduce a direct tax, but then direct tax is defined as an income tax on exports. So then the question is this really a direct tax or is it indirect tax? And the foreign countries have already informally indicated they think this is pretty much clearly a direct tax because of the wage deduction. So they would say, look, compare it with the VAT. Here you get a deduction for wages, and you disallow the wage component or input in fact, you disallow everything on inputs, but among those things you're disallowing is the wage component. So you're treating the two unequally, and that by itself is sufficient, perhaps, to cause a violation. Now, there's been some talk floated and sort of informally recently that one approach that the House might take to fix this aspect of the blueprint is to disallow the wage deduction and replace it with essentially a reduction of the payroll tax. And that's attractive because reducing the payroll tax is a very good political thing, and it's something that a lot of groups have been asking for. And certainly, if they took that approach, or I think it very likely eliminates the GATT problem. It doesn't deal with the NAFTA and the free trade agreement issue, which they have a different focus. So they're trying to say that prevent any indirect tax on imports. They use the term charges. So the question is whether this tax would be a charge on imports. I'm not sure these are considered the most important since President Trump has indicated his disdain for the NAFTA agreement anyway and desire to renegotiate it. The third thing that Mark Prater mentioned was the impact of the changes on other aspects of the business tax provisions and the business tax base. And that's a very complicated issue by itself. Now, there are numerous other issues, and I'm sure the Senate is concerned about these as well. I'll just mention some of them. So like I said, the economists expect that the dollar will appreciate, and doing so will offset the extra cost of the tax. So it's expected to leave the after-tax cost of goods the same on both sides of the ocean. So if that's right, the retailers and other major importers that have been concerned about it should not be hurt. The theory is the strong dollar means that the exporters have less profit, but they're not taxed on it. The importers report more taxable income, but they pay less because of the higher dollar, and they will pay tax on that, and that offsets the benefit of paying less. Obviously, it's easy to say it. Economists claim they have proven it by equation, and we won't go into that. So in effect, the U.S. is causing, by enacting this, it would be causing the dollar to appreciate, and then it would be taking a slice from the importers, from the imports, and giving a slice to the exports. And that's, like I said, that's expected to raise revenue net. You can see that it would only raise revenue if the imports are greater than the exports, and only for so long, and only to the extent that the imports are greater than the exports, which is thought to be always a temporary thing. Temporary can mean 10 or 15 years, and in this case, I think projections are we'll be a net importer for at least, I don't know, 15, there was still projected net revenue for the next 15, 20 years, I don't know. That can change very dramatically based on reactions of taxpayers and businesses, and I'm sure that number has varied all over the place. So I do recall one of the revenue estimators, one of the private organizations, had a number as low as $1/3 trillion, whereas as revenue generated, whereas the official estimate is closer to $1 trillion over 10 years. I think that, well, we'll get into how that interrelates, or maybe we'll get into how that interrelates with the cost of the expensing provision. So, but there's a risk that it won't fully appreciate, and to that extent, obviously, the importers are very concerned. And one of the complications, and it's a little hard to get your arms around, is that if you have partnerships, which are major businesses these days, and S-corps, which are certainly major businesses in privately held context, and they do export and import. If you have these guys taxed at 25% and regular corporate rate 20%, it's hard to see how both are going to be made precisely whole, even on that basis. And then there's the timing issue, which has been written up about quite a bit as to how soon, if there is this FX adjustment, how soon it takes place. Now let's say everything works hunky-dory, there's an FX adjustment and it takes place quickly. Is that the end of the problem with the effect on flows? There's one little problem, and that is that if that happens, then there's this huge, everybody agrees, the economists have said, there's this huge outflow of wealth from the U.S. It's a drain, it's an effect on the assets. So U.S. persons holding foreign assets are adversely affected because the value of the dollar has declined, the value of their foreign asset position has declined, and foreigners holding U.S. assets are in the catbird seat because the value of their U.S. assets has increased. So you've got a bad result either way. You either have that bad result or you have the failure of the exchange rates to adjust so that importers are adversely affected. And you're sort of saying to yourself, well, I can't, this is like, I can't even pick my poison because I'm affected one way if I have assets, I'm affected a different way if I'm an importer, but it's going to be bad for somebody. Now, the fact that there's general parity at the level of consumers, as the economists would say there is, sort of brushes by the fact that there's a lot of, that's on a macro basis, it's on a after foreign exchange rate adjustment basis, it's on an after-tax basis. So obviously there's a lot of room for differentiations. And one example is the taxpayers that are exporters that have a large amount of losses generated as a result of expensing. So this system is combined with expensing. They get to expense all of their capital expenditure and inputs, inventory as well, even on the portion that relates to exports. So by definition, since the exports revenues don't go into the tax base, you just have a big deduction on the export side of things, and that can exceed the tax base on the rest of their income in some cases. It's a bigger problem for smaller companies than for larger companies, but and I think it was thought that even 10% of the larger companies would have this kind of a situation, and about 50% of smaller companies would. So what do? They have to monetize those losses. The economists would say, well, that's not such a bad thing. We really wanted it to be the benefit of the of the border adjustment to be refunded, to be paid back. And if you don't, you're essentially saying you have an uneven system because you're saying that the expensing is not really a full expensing for exporters. So if you're going to have an even-handed system, they're going to have these losses. They should be allowed to monetize them. So does anything go? That's a big question. If anything goes, they can do lots of different games, as has been pointed out, including just round-tripping, making sure that the loss company buys the import, the profit affiliate sells outside the U.S., and it may involve different groups, not necessarily affiliates, but it could be done inside the group as well. And there's a huge question as to whether that'll be tolerated and whether it'll be felt to be benign. But at the end of the day, there probably will be fences around it.
So, Peter, can I ask you, should we figure all of this out before we jump, or would we be better off jumping? Because you could actually imagine less political resistance as long as people don't know how it's going to affect them.
Yeah.
And when everybody knows who the winners and losers are, you get the political deadlock that we've experienced now for so long. I have other problems with some of the things that are not specified in what we've been calling the blueprint.
Yeah.
But why not just leap if it seems like it might be a good idea?
Yeah, I think that was certainly, we shouldn't say. It's been speculated that is often part of the strategy of legislators that have a legislation to enact, that you don't always want to give people too much time to raise objections or nothing will get passed. I've already indicated that my feeling is in this case, because it is such a major part of the system and it is so complicated and is so novel that we just can't, we shouldn't be rushing into it. We'll see. We'll see. I think I guess I did want to refer to just a couple of other things that are, certain industries have to be carved out, obviously. Think of the leasing industry, but also just think of the transportation industry. So should you have a different effect? Should you be paying a tax to ride on Lufthansa instead of on Delta, let's say? That makes no sense, or at least I don't think it does. We have internet transfers, so business or even just package delivery imports direct to customers. The basic approach of the border adjustment provision has been to say you don't get, if you're a business, you don't get cost of goods sold deduction included, or you don't get a deduction for service payments or royalty payments. But what if it's a business to consumer? The only person in the U.S. is a consumer. We have to create a whole new system to deal with that. We have to either require the foreign sellers to register and pay the tax in the U.S., or we have to require some sort of withholding against the amount paid by the consumer, in which case the foreign seller may ask that it be grossed up and the consumer bears the tax. But none of that is simple. Never really been done effectively. The VAT systems have had to struggle with that to some extent. I think I'm probably I should be running out of time, but I haven't quite yet, I see.
We'll have another bite at the end.
I'll just mention what Eric mentioned in terms of the state taxes, hugely important, and financial statements, financial books, hugely important. Companies are going to have to keep many different sets of books because they have different tax regimes for financial accounting, different tax regimes for states that conform versus states that don't conform, for earnings and profits and so forth. So extremely complicated. So the things so we cut through the rest of it and say, what are the alternatives? Well, one alternative is being floated is, can we have a 50% BAT, 50% border adjustment? And could we, that's all that's officially been floated. But another possibility is Well, could we just get rid of border adjustment and simply scale down the expensing? We don't need 100% expensing. Maybe it's 50% expensing. Maybe it's bonus depreciation or something like that. Keep the net interest deduction, maybe not have the rates reduced quite as much, and that could work as well. So leave it at that.